Now, we often analyze markets by quarter or by earnings season, but what if some of the most consistent behavior doesn't happen across months, but actually inside months, intra-month? Now, today we're looking at the intra-month seasonality for the S&P 500, the Dow Jones, and the Nasdaq-100. And the key question is really simple. Is there a recurring structure inside each month that investors consistently underestimate? Because if that is, that can change how we think about timing, even if we're in very strong bull markets. Now, if we look at the S&P 500 here first, the chart shows the average inter-month performance of the S&P 500 over the last decade. And what immediately stands out is that the moves are not random. The index points to strength early in the month. You can see here from day 1 through to day 8, day 9, that the S&P 500 has an average return of 0.32% and a 64.17% winning trade percentage. Then mid-month, as we pass the 15th day of the month, the intra-month tendency sees momentum slowing and mid-month returns flatten. You can see the average return is actually negative 0.13% and a 55% winning trade percentage. But importantly, there is often a renewed push higher into the final stretch of the month. You can see again 63 winning trade percentage and an average return of 0.47% from day 23 to day 29. Now, if we look at the Dow Jones, we see a sort of a smoother kind of pattern, but the same shape. You can see the intra-month from here to here, from day 1 to day 9, there's a 60% winning trade percentage and average return of just under 0.5%. Again, once we get into the middle of the month, we can see that returns flatten and there's a negative return only marginally, but negative 0.06% and a 53% winning trade percentage. Once again, there is a renewed bias of strength towards month end, and you can see here from day 23 to day 29, again an average return of 0.41%, 59.66%. So the Dow reinforces that this isn't just kind of a growth stock phenomenon. It appears to reflect broader institutional flow dynamics with a very similar pattern to the one we saw in the S&P 500 intramonth. Let's now look at the Nasdaq-100. And what we see again, it's an amplified but familiar pattern. Here's the same rhythm. Typically, early month from day 1 through to day 9, average return of 0.41%, 62.50% winning trade percentage. Then once we get into the middle of the month, once again, from day 15 to day 23, a negative return, 0.10%, 55% winning trade percentage. Again, mid-month considered consolidation. And again, we see late month strength as we go from day 23 to 29, again an average return 0.55%. So when we consider all three of these major indices, the Nasdaq, the S&P 500 and the Dow Jones, what we see is the same broad rhythm. Early month support, mid-month hesitation, and then late month reacceleration. Now, the fact that this pattern appears across different index constructions strengthens the case that this is tied to recurring capital flows and not just random volatility. So why does this happen? Well, intramonth seasonality often reflects structural flows such as pension and retirement contributions, which often come around the turn of the month. There's systematic allocation schedules, corporate buybacks. There can be ETF and fund rebalancing around month end and month start. And these flows, as well as end of month positioning, don't just disappear in bull markets or bear markets. They create a rhythm that kind of repeats itself. So the reason this matters for us is even when the indices are trading near highs, the structure can still influence short-term behavior. And if we're entering, say, a historically stronger part of the month, that context really matters. Also, if we're approaching a historically softer window, mid-month consolidation, that matters too. So this doesn't replace macro analysis at all, but it complements it. It provides a statistical context to the intra-month pattern which SeasonX reveals. So the key question becomes, is the market currently aligned, right, with its historical intra-month rhythm, or is it diverging from it? Because divergence can be just as informative as confirmation. And while nobody can predict the future, analysing intra-month seasonality provides a structural lens, helping investors make more informed decisions.